Good afternoon, everybody. Thanks for joining me. I hope everyone's having a fantastic day. I know it's supposed to be about 120 degrees today, so hopefully everybody's staying cool. This is a really unique way to do the halftime report. Typically, we host these at country clubs or other various locations, but because of everything that's going on, we're actually doing it digitally this time. So what I hope you are able to do is set up about I would say about 30 or 40 minutes in order to go through the halftime report. We're going to be covering a variety of topics, not only kind of what happened in the first 6 or 7 months of this year, but also some of the fundamental things that we're going to look forward to in the last half of this year. I do want to point out that at the bottom of everybody's screen, there is a chat button. So as we're going through the presentation, if you do have questions, make sure to type those in. They'll come privately into me. And then at the end of the presentation, I'm going to try and go through as many questions as I can and answer them to the best of my ability. And then before we get started, I did want to make a point that we will be having, I believe it's August 26th, is our last series for August of Whalen University, which is Think Further, where we're actually going to interview some top physicians, biomedical engineers, and scientists and get their opinion on kind of where the world's going to be over the next 5 to 7 to 10 years. Because when we do invest clients' capital, we don't want to invest just for now until the end of the year. We want to invest over that long period of time. So make sure you register for that one. I believe it's August 26th, which is a Wednesday, so you can join in. But without further ado, let's get into the halftime report, which is something that I'm extremely excited for today. And, like I said, we're very happy that all of you are here and look forward to sharing this important information with you. With regards to questions, as I said just a few seconds ago, you do have the ability to type in questions at the bottom of the screen, either on your phone or on your computer. There will be a chat button that if you click that chat button, it will allow you to type me personal questions. So you can do it now through the presentation, but I will go through as many of those as I can at the end of the presentation. So not everybody on today's call is a client, but basically what our firm does is it provides a range of services with the primary goal of helping our clients pursue their unique financial objectives, and everybody is different. What we want to help is develop a financial strategy tailored to your goals, time horizon, as well as your individual risk tolerance. And before we get started, here are a few disclosures I'd like to bring your attention to. It does keep the attorneys happy as well as the regulators happy. And it basically discusses that securities are offered through LPL Financial, a registered investment advisor. We are separate companies. And anything that we do say today is not tax or legal advice. And any of the indexes that we mention are unmanaged and not available for direct investment. So, please take a second to read that, and now we are going to get on with the presentation. So today, one of our goals today is to discuss some factors that really influence the market performance during the first half of 2020, then review the underlying fundamentals. It would be impossible to cover everything that's happened so far, but we believe that focusing on some key developments may help give a clearer picture of the actual markets themselves. So today we will review where we've been, some key economic fundamentals, and what may lie ahead in the second half. And this broad view is really designed to help you, one, stay informed, but two, also give you a better understanding of some of the perspectives guiding our investment process for our clients' hard-earned dollars. So let's begin by reviewing how the stock market performed during the first half of 2020. So here's a snapshot of the S&P 500 index for the first 6 months of 2020. Now this goes through the end of June, which is where the majority of our data is, and I can discuss a little bit about the month of July as well. But the S&P 500 index tracks the market capitalization of basically 500 large domestic stocks. And the index is often viewed as the common benchmark for analyzing the performance of the U.S. economy. And the S&P 500 ended 2019 at 3231. At the end of June 2020, the S&P closed near 3,075, as you can see in the bottom right-hand corner. So let's look at some of the key events that affected not only stock market performance in the first half of the year. And as we review these milestones, keep in mind that it was an extremely volatile period, which reminded us all of the return and principal value of stock prices, that they will fluctuate as market conditions change. So as the new year began, stocks marched higher in February and March, and this was primarily lifted by the completion of that phase one trade deal between the US and China. There was also a monetary policy that was engineered to stimulate economic growth and activity. And as we all know, the market narrative really changed drastically as COVID-19, the outbreak itself, spread throughout China. And as it grew, the Chinese economy was really devastated, and other countries began to report cases of their own. The US market remained, unfazed until basically February, when health officials announced what was quickly becoming a pandemic would likely have a widespread impact here domestically. So February 19th was actually the height of the market for this year, specifically on the Dow. I know the S&P is just touching that number right now, but February 19th was the top of the market. So in March, stocks swung wildly on not only news of economic contraction, but also the rise in domestic infections, as well as the general uncertainty regarding how far the economy might fall and how long the pandemic might last. Then the stock market moved higher in April as investors started to really evaluate corporate earnings and some troubling economic data. And then the gains started to accelerate after April 21st on news of positive results from clinical trial investigating of a treatment for COVID-19. So that April 21st date was the first positive results from a clinical trial for COVID-19, which really kind of put a base in the market, because if you can control the spread of the virus or control the amount of damage, it gives you a baseline to really work off of economically. Then we get into May. And stocks in May notched another solid gain on May 18th, when the Federal Reserve basically came out and restated its commitment to do whatever it would need to do to support the economic recovery. This followed by, on May 26th, the day following Memorial Day weekend, stocks surged that day due to rising optimism over economic reopening, reported declines in new COVID cases, and further news surrounding the development of a potential vaccine. Then that brought us into June, which was the most volatile month that we have seen since March. And in early June, that optimism, which had driven stock prices higher those past several weeks, basically slipped away. And on June 10th, the Dow dropped 1,800 points. If everyone can remember that day, June 10th, the Dow dropped 1,800 points on reports of a jump in COVID-19 cases. Now, this sparked worries of a second wave slowing the economic recovery. That was the month of June. And even though it's not on here, in July, the S&P 500 rallied 3%, and is continuously, as we're speaking, approaching an all-time high based off of vaccine optimism. And it seems as case spreading seems to be slowing down on a countrywide basis, and hospitalization rates aren't spiking as far as what people predicted in June when the Dow dropped that 1,800 points. So this is something that we looked at the end of, or the beginning of this year at our State of the Markets at Red Rock Country Club, where we work with a large number of money managers, and we use their insights to help us kind of guide and predict where markets could be going. And I know Giotto's on this call, and at the end of the meeting, I wrote a specific number on the S&P 500 for my year-end target. So basically what this looks at here, at the end of each year, these various media outlets compile Wall Street's analyst predictions for the year ahead. And what this slide shows is a variety of projections shared at the end of 2019. And what we want to look at here is how those predictions compare to reality so far. So as I mentioned on that previous slide, the S&P 500 finished the first half of this year at 3,075. Right now, the S&P 500 is 3,375. So the group average here gave an S&P 500 end of the year consensus for 3272. And he can correct me if I'm wrong. He'll probably give me a call. But I believe I wrote down 3,400 or 3,500 as the end of the year target for the S&P 500 on that piece of paper before you left, Giotto. So now this is all at the current snapshot. There's a lot of time left for the end of this year. But basically, what we're trying to tell clients is that the S&P 500 is fully valued from our standpoint at that 3,300 number. Even the most optimistic was from Credit Suisse at 3,425, which would be about a 8% increase from where we're at today in the markets if all things work out perfectly. But remember, it is election season. Volatility tends to pick up from now until the end of the year. And then obviously the election results are going to play a role in what the S&P 500 does from November through December. But 3272 is that average. Despite COVID, despite technically being in a recession, somehow the S&P 500 is above that consensus group of 3272. And we can get in a little bit more details about the fundamentals towards the end of the presentation. But predicting where the S&P 500 will be by the end of the year has become even more difficult now than it was at the end of 2019, since it's challenging to estimate corporate earnings. And this is especially true now since no one has a clear idea of when American spending and business investment may return to those pre-normal levels. But nevertheless, we'll discuss a little later in the presentation what Wall Street analysts may be looking for during the second half of 2020. So this is going to bring us to what drove U.S. equity market performance. And what we want to look at is some economic and financial indicators to help us understand, essentially how we got here. And for all of the clients who have been attending these halftime reports or state of the market reports, the next few slides are going to be very familiar because it's ways that we track economic and financial data. So these are basically speedometers. And to put today's economy in perspective, let's first look back at January of 2010, when we were first emerging from an economic slowdown. So here you'll see 20 speedometers representing 20 indicators from corporate profits to energy cost. And as you can see, 17 of those 20 indicators were in green, which basically suggests that the economy at that time had a solid foundation. None of the indicators were red. So this was January of 2010, basically around the bottom of the U.S. Stock market when we first started to come out of the technical definition of a recession. Now we're going to fast forward to January 2020. And this exact slide was on our State of the Markets presentation back in, I believe it was February. So if we look at January 2020, 10 of the 20 indicators reported positive or strengthening numbers. But you can see that an equal number of indicators had a neutral or negative rating. Now, in particular, the political environment and geopolitical risks were the only ones at that time that were in red. And what these indicators reflect is a forecast of the next 3 to 6 month time horizon. So now we fast forward to June of 2020. Look at the difference. There's January. Here's June. Okay. And in June, the speedometer suggested a much more cautious outlook. So as we've been talking with clients, where it makes sense, we've been taking a small amount of risk off the table in select portfolios to hedge kind of the big rally that we've seen based off of the speedometers that we're following. So the widespread influence of COVID-19 is absolutely reflected in many of these indicators. So we've seen some states open certain businesses, then adjust the situation due to outbreaks. Some studies may continue to give mixed signals until we move closer to a potential vaccine. But you can see business outlook, corporate profit growth, international economic outlook, equity market valuations, geopolitical risk, as well as disposable personal income, which is actually, in my opinion, that needs to be in the yellow based off of not only the stimulus money, but the unemployment benefits. This is the first recession in U.S. history where we've seen personal disposable income increase during a recession. It almost always decreases because people, inevitably lose their jobs. But that's kind of the speedometers that we're watching. We think that the labor market is strong enough to recover. As you can see, unemployment, we'll go over this in a second, topped out at about 15% or so, the highest since post-World War II. And I believe the latest economic numbers that came out on unemployment were right around 9 or 10%. So we've seen a pretty significant decline as far as a percentage. And we expect that to continue as long as trial vaccines continue to show improving data, as well as virus spreads continue on the pace that they're on, which seem to be relatively declining on a U.S. base versus individual hotspots. So by now, obviously every American has been affected in some way by the turmoil brought on by COVID-19. And it's fair to say that the pandemic produced unprecedented economic disruption and upended the capital markets in a way that we've never seen since the credit troubles of 2008. And in the next several slides, what we're going to do is we're going to examine how the pandemic played out on key drivers of stock market performance. So the first is I want to spend a few minutes on the Federal Reserve and how its monetary policy responded to combat the disruptions resulting from COVID-19 and the subsequent lockdown of the US economy. So stemming from the lessons learned during the 2008 crisis, the Fed acted much more quickly and decisively to address the strains in the capital markets that were already beginning to emerge. So very different than 2008. The Fed acted almost immediately and with a nuclear bomb of money versus what they called back then a bazooka. So beginning with the surprise Sunday evening press conference on March 15th, the Fed Chair Jerome Powell announced a drastic reduction of the federal funds rate to 0, as well as committing up to $700 billion in asset purchases to maintain liquidity in the credit markets. And if we've met, you've heard me say this in a multitude of times, without a healthy credit market, you cannot have a healthy stock market or economy for that matter. Why? If we all owned a business and we had trouble paying back our debt, we were a publicly traded company, and we had trouble paying back our debt, as soon as news broke that we couldn't pay back or access credit, what would happen to our stock prices? They would deplete, they would go down. So that's why the Fed acted so aggressively to support the credit market starting that March 15th. Now, the market greeted this move negatively, believing that the Fed saw more trouble in the market and had factored into stock prices up to that point. So from that March 15th meeting for next about 2 weeks, the markets were in absolute free fall. And they continued until about the end of March, and technically March 23rd. So as this timeline illustrates, the Fed continued to implement new measures to help steady the financial markets. And while the Fed implemented more programs than we have outlined here, let's take, what I want to do is take a look at some of the key policy initiatives put in place during the worst market slide. And they include the following. So they created a commercial paper funding facility to buy short-term unsecured debt and was crucial to ongoing business funding. Second, the creation of a money market fund liquidity facility to promote the purchase of assets from money market funds, ensuring value preservation of money market accounts. Third, they established funding to support credit to large companies, including reviving the 2008 Term Asset-Backed Security Loan Facility, or TALF, program to prop up corporate bonds. And then with the passage of the Paycheck Protection Program, or PPP, and the extensive distress in small businesses nationwide, the Fed introduced a lending facility to buy PPP loans. This helped to facilitate bank participation by taking non-performing loans off the bank's balance sheets. And then lastly, they introduced sweeping changes to the Main Street lending program in order to make it possible for a wide range of small and medium-sized businesses to actually apply to those loan facilities. So what does all that mean? Remember back on the image that I showed the stock market performance in the first half of the year? On May 18th, stock notched another solid gain when the Federal Reserve restated its commitment to do whatever it takes to support an economic recovery. So that's what all of this means. That the Fed, unlike 2008, which I think we could have seen a market correction greater than that 55% that we saw in 2008, if the Fed didn't take these extraordinary measures to support not only the liquidity of the markets, but the credit system, as well as provide opportunities for banking institutions to provide PPP loans so they wouldn't have to just loan out money and lose it. So the next is corporate earnings. And this chart shows the relationship between changes in the S&P 500 performance and the 12-month forward earnings per share, or forward PE. As you can see, the two lines have generally moved in the same direction over the past decade, from left to right. But what has happened in the last few months is that the volatility in stocks and earnings is the result of COVID, as you can see on the far right-hand side of that chart. So obviously I have to say this, a couple reminders: past performance does not guarantee future results. And over the next 10 years, the correlation between stock prices and corporate profits may look completely different. Okay, so I have to give that disclosure. But secondly, individuals cannot invest directly in the S&P 500 index. And thirdly, the principal value of stock prices will fluctuate as market conditions change. Got that out of the way. But what we want to do at the highest level is the Federal Reserve has three functions. First is to provide effective payment systems for the US, to regulate banking operations, and to conduct monetary policy. So when conducting monetary policy, the Fed is tasked with supporting maximum employment, stable prices, and moderate long-term interest rates. Those are the three fundamental mandates of monetary policy delivered by the Federal Reserve. So as it works to uphold its monetary policy goal, one of the indicators that the Fed monitors is the overall level of consumer prices. Now, consumer prices just came out today for food and discretionary items, and those rose actually 6 or 4.3%. So pretty big jump in food prices from the last reading year over year. But why they follow consumer prices is because it helps to determine whether to adjust interest rates. And the Fed has stated it is comfortable with inflation in that 2% range. So this line graph shows the core consumer price index, or core CPI, over the past 50 years. And everybody remembers in the late 70s, early 80s, when a mortgage was going for about 18%, you see that big spike there. The core CPI, what it does is it tracks urban consumers' pay for a specific group of goods. And this measurement doesn't include energy or food in the core CPI because those prices are often fairly volatile depending on what's going on in the world. So some economists use this measure to basically track inflation, okay? And as you can see in this chart, the pandemic's influence on inflation trends have been dramatic in recent months. And for example, when most states were urging residents to stay at home in May of 2020, energy CPI dropped by 18, almost 19%, right? Because nobody was driving. As you can see right there in that chart, energy CPI down 19% in the month of May because we weren't going anywhere. Food increased by about 4% in the month of May because there was an overabundance of demand for food delivery and food consumption because we were home. But core CPI and headline CPI still year over year have only been about 1.2 and 0.1. Next is unemployment and wages. And we talked about this back in February. The reverse indications of not only employment, but wages, they're inversely related. As you can see, as unemployment goes down, wages tend to increase. Why? Because there's less amount of workforce out there. As unemployment rises, wages tend to go down because there's 10 people looking for the job instead of just one person looking for the job. So if we take a moment and talk about wages and unemployment, what this graph shows is that the unemployment rate and year-over-year wage growth for the past 50 years. And like I said, what's interesting to point out is that they're inversely related. So, but who could have ever, what's interesting here is who could have ever expected the change in recent months due to COVID-19? And as you see in this chart, unemployment jumped to, call it 15%, 14.7. And that was in April, that was the peak. And in May, it fell to 13.3. And last week's unemployment numbers showed right around 10% unemployment. So we've had a pretty significant decline. If you do that mathematically, that is about almost a 30% drop, 29% drop in the number of people that are on unemployment just from April until June. Now, where will we go for the rest of 2020 is the big question. And many people on Wall Street, the biggest and the brightest mind, what they're trying to do is figure out what happens with unemployment and how closely it'll be aligned to the outlook for COVID-19. And I think they're going to be very closely aligned. And in my opinion, because of the consumer's mentality and changes in behavior in general, whether that's more people working from home, everybody knows of Dana, and she's been working from home since everything kicked off in basically February or March. And she's head of marketing for a big financial institution, and they've notified her that she's going to be work from home basically forever to cut down specific costs and expenses. So there are going to be systemic changes to how our economy functions after this pandemic, very similar to what happened after 1918. So we still see a relatively high unemployment rate going into next year, even if we get a vaccine, because of the structural changes of our economy moving forward. So it's going to be up to policymakers as well as corporations to figure out a way to navigate those waters going into 2021 and beyond. Next is basically the consumer sentiment, right? So this gives us, this comes from the University of Michigan. This is the Consumer Sentiment Index, and it's one of the most widely used sources to help analysts really understand how the average consumer feels about the economy. This index is also extremely valuable as it surveys at least 500 residents of the continental US each month by phone. The survey uncovers consumers' opinions regarding their finances as well as business conditions in the country. And understanding how people feel about the economy is essential because consumer spending accounts for more than 2/3 of GDP. So what this chart shows is a long-term upward trend in consumer sentiment. But like many other indicators that we've seen today, COVID-19 has changed that outlook. And while most consumers believe that economic conditions could hardly worsen from the recent shutdown of the national economy, prospective growth in the economy is more closely tied to progress against COVID than anything else. And in my opinion, the early reopening of the economy has undoubtedly restored some forms of jobs and incomes, but it has come at a probable cost of an uptick in the spread of the virus. So it's not surprising to see COVID additionally affecting consumer sentiment because of the uncertainty in the economy. Now, this is existing home sales. So for all the realtors out there, I'm sure you've seen this chart on a national basis. And what this shows is the long-term trend in existing home sales that go back about a year or so. And what I want to draw your attention to is that far right side. You may have to squint just a little bit, but the last figure is 3.9 million, okay? A drop, which is a huge drastic drop just a few months earlier. And, one question that I would have for everybody is our existing home sales a leading economic indicator or a lagging economic indicator? And just a quick refresher on leading and lagging before you answer that. Leading economic indicators are statistics that tend to precede overall economic trends. Building permits, for example, tend to be a leading economic indicator of new home construction. Lagging indicators are statistics that tend to follow a particular economic trend. So returning to that question that I just posed to everybody in this meeting, are existing home sales a leading or a lagging indicator? Well, they are a lagging indicator because they tend to be influenced by changes in mortgage rates. So we saw the significant drop then. This is only through May. We've actually seen a pretty significant rebound in existing home sales, almost to pre-February heights. based off of the extreme drop in interest rates. So this chart isn't exactly fair because it only goes to the end of May, doesn't include June or July. And we've seen a tremendous amount of refinancing in there, and existing home sales actually holding up fairly better than what that small snapshot in time indicates. Now, here is something that looks at what we call the household debt service ratio. And this shows a pretty critical trend, in my opinion. It gives us some perspective on how much revolving debt, so credit cards, things like that, households actually manage. And as you can see, revolving debt hit a high in Q4 2007, and has never approached that number since then. And what this begs to ask is, does it mean Americans are using debt more wisely? Is it because it's harder to obtain debt over the last 10 years because of what happened during the credit crisis? And to me, that's uncertain, but the overall downtrend means debt payments as a percentage of disposable income still remains below about 10%. And why I want to point this out is because I'm a firm believer that even though there are challenging hurdles that the economy has to get through, this is something to look forward to as far as an optimistic point of view, that we had only about a 9 to 10% debt to income level going into this crisis, meaning that consumers, as they come back into the economy, as it starts to reopen, they're not overly burdened, which is why the government, whether it's Congress or the Fed, is trying to build a bridge from point A to point B, where we're at now, to where we do have a coronavirus vaccine that gives consumers and businesses confidence again to get back out there, hire individuals, bring them back, because demand was not the issue and debt was not the issue on an individual consumer level, compared, even if you go back to the 1980s when it was, roughly about 10.6%. So this is something very important to understand about the underlying consumer, even during the crisis. Can they maintain their float, whether it's on their mortgages or other debt payments? And I think that they'll be able to for the large majority of individuals coming out of this recession. So before we move on to our outlook for the second half of 2020, let's take a moment to consider, the variables that could upend such forecast, right? So there's a lot of variables that could really change the forecast that we've got for the rest of this year. And, the market's resilience in the first half of 2020, in my opinion, can be attributed to the unprecedented monetary and fiscal support, as well as the optimism regarding a potential COVID-19 vaccine. Those three things. And while the Fed has promised to continue supporting economic recovery efforts, it remains less than certain that the federal government can maintain its pace of spending, or that medical professionals will discover a vaccine in advance of a new flu season, right? And people don't talk about that. They talk about a second wave, but you also have to remember we're going to enter into flu season soon. So everything that we're saying is based off of those three items: Congress, the Fed, and a vaccine. And depending on what happens with the presidential elections or the shifts or non-shifts in Congress, will they be able to continuously provide support to the underlying economy? And as we've all seen in recent news, they seem to be finding trouble on both sides of the aisle to come to just a simple agreement on how to help America. So all of the things that we're going to talk about moving forward are going to be predicated on those three things. Now, in addition to the upcoming presidential election, other political headwinds could cause stocks to potentially retreat. The potential for a new wave of COVID-19 cases and a slower than expected economic rebound, as well as heightened geopolitical tensions, could all have an impact. So we also can't discount the possibility that, just like we saw with the emergence of COVID-19, that there is always the possibility that what trips the market up will be something no one could anticipate. It's what we call black swan event. In this industry, black swan events are something that you really can't predict, much like COVID-19 as far as the depths that it could have reached and the impacts that it had on not only the U.S. economy, but the globe. So, of course, no one predicted what would happen in the future, but we hope the following perspectives help you understand what we believe may be on the horizon. So let's get into the last portion of the halftime report. So second half outlook. First, what I want to talk about is market forces and dive into some of these forecasts. So sub-market strategists employ what's called a bottom-up target price to set their S&P 500 target index. When setting a bottom-up target price, what market strategists focus their attention on is estimating earnings for all of the S&P 500 companies. So by contrast, a top-down investing target price places a greater emphasis on macroeconomic factors for when making the investment decision. So bottom up is actual corporate earnings, top down is macroeconomic issues. So what this shows is the expected price target of the S&P 500 and compares it to the actual closing price of the index. So the closing price at the month end, now this goes back into April, was $27.49, and the bottom up price target month end was $32.38. So a word of caution on this type of analysis: just because the closing price is below the bottom up target price, it may not mean that the market is actually undervalued, right? So the bottom up target price is a theoretical target, and it may or may not ever get reached. And as long as you can see in the chart, the bottom up price target has been above the closing price for some time now. So this goes back to end of last year. So it's interesting to see where that is compared to what the actual results of the market have been. And just because it's lower than that actual target price doesn't mean that the market is undervalued. So here are a few things to keep in mind before we move on about GDP. Is that the market has really rallied from April, the bottom of April or the start of April until now, and it hasn't gone up perfectly. And what I try to relate to individuals is, at a minimum, what COVID has done, and a lot of people don't understand that the Dow is actually about 8 or 10% off from the highs that we saw in February. So it's really the sectors that have information technology and technologically exposed companies that are investing for the next 5 and 7 and 10 years that are being the primary benefactors of the market rallies. Why? Because at a baseline minimum, what COVID will do, and there's no uncertainty in the statement, COVID will change the fundamental spending behavior and patterns of not only consumers, but also businesses. And those companies that were already preparing for that digital transformation or that digital economy or that digital landscape for their business are being rewarded. So we're going to look at GDP, and much like the previous chart, COVID-19 is having a rather dramatic effect on GDP. And in this one, real gross domestic product, or GDP, is expected to drop anywhere between 4 to 10% this year alone. And the Federal Reserve's chart, which is what this is, also shows a dramatic rebound in 2021 and 2022. So you can see the actual GDP on the left trending, that line, that's actual numbers. 2020 forecast on the low end 10%, on the high end -4%, with a pretty significant rebound in 2021 going from basically either -2 on the low end all the way up to 6. So the positive on here is that the Fed is actually seeing potentials for trajectory to continue going into 2021 and 2022. And I believe that that is based off of the fundamentals that were occurring inside of the economy prior to February of this year. Corporate earnings. Why is this so important? Well, when you purchase a stock, you are purchasing a right to own a portion of that company's future earnings. That's why you don't invest in stocks for today or even tomorrow. You don't invest for the days or the weeks, you invest for the years. And it's because stock prices are based off of future earnings, specifically corporate earnings. And as a wise market strategist once told me, he said, stock prices are based on earnings, and more importantly, what price people are willing to pay for those earnings. So what that means is Amazon unjustified at that certain market level or that PE? Is it justified if they are changing the way? What price can you put on the way of changing individuals' behaviors of consuming things? Or another company like what we're using today, this webinar service. Is that company justified at that multiple if they're changing the way people do business in a work from home environment? And that's what the market's there for, is to figure that out. But what this chart shows is the trend in corporate profits in the United States since July of 17. And you can see profits dropped 12.5% to $1.672 billion in the first quarter of 2020. Now, it was the sharpest decline in corporate profits since the last quarter of 08, as you can see back there, 1695 on the far left, 1672 in January. And you may also have heard the expression that the stock market operates as a discounting mechanism, right? Future earnings discounted back to a current price. And quickly processing all the available information, what's known as the modern portfolio theory, and potential future events, right? So efficient market theory and the MPT, or modern portfolio theory, basically tells us that stocks on any given day have all known news priced into them, everything that's known. And clearly the stock market isn't dwelling on the near-term drop in earnings, as evident of where the stock market is today. And it appears to be focused on earnings potentials in 2021 and beyond. So in our opinion, what the market is doing is basically taking 2020, putting it in the shredder, taking the shredded pieces, putting it in the garbage can, and lighting that garbage can on fire. It's forgetting about 2020 altogether. And what instead it's doing is it's focusing on 2021 and 2022 and beyond. And why are they doing that? Because something like what's happened this year is not only unprecedented, but you can't even calculate where these earnings are going to be going. They have a good idea based off of those three assumptions that I named prior to going over our forecast, which is the president, Congress's policy, vaccine, and the Fed. All of those things. So what's ahead basically in short-term interest rates is what I wanted to go over towards the end of this. Why are short-term interest rates important? Because a lot of people finance things based off of short-term interest rates, whether that's business loans, home purchases, home refinancing, and all of that is cash flow for individual investors. So as we discussed earlier, the Fed is watching the economy as it assesses whether to further adjust monetary policy. And with the Fed funds rate at 0, any reduction in rates, in our opinion, are extremely unlikely, especially since the Fed chair has previously said that he is not inclined to move into negative rates. We all know how well that's worked out for Japan. We know how great that's worked out for the EU and most of Europe. Negative rates are not conducive to economic growth. So we see it very unlikely that short-term rates, at least the discount rate that the Fed controls, will move into negative territory. So the Federal Reserve Open Market Committee is scheduled to meet 4 times in 2020. So upcoming in September, the 15th to 16th, November 4th through the 5th, and at the end of December. So they're scheduled to meet at these times to determine where they're going to do with short-term interest rates. And in my opinion, they're not going to let the stock market really dictate what they're going to do with those. So typically, if the Fed is going to make an adjustment to interest rates, they will announce that change following those 2-day meetings. And here's another relationship to understand. Bond prices and bond yields have an inverse relationship. So in other words, when bond prices go up, yields go down. And after experiencing years of low interest rates, many investors may be actually surprised to realize their bonds can lose money if sold before reaching the maturity. And bond values may decline during periods of rising interest rates. So if and when we get out of this pandemic and the Fed starts to increase interest rates or yields go up, what happens to the price of those bonds on the right? They tend to go down. That's why it's important, if we have bond or fixed income in clients' portfolios, that we are tactically managing those positions or working with managers that actively trade those positions so that we are not just stuck in one specific bond for a long period of time, hoping that it matures at par, and not worrying about the daily fluctuation of interest rates. So it's just important to point out that if we're at zero now and the economy starts to recover, it is more than likely that the Fed will increase rates in the future, and how that relationship coincides with bond prices and bond yields. So in our opinion, though, it's important to stay focused on the fundamentals. And I know it's really hard to get lost in the headline noise while managing your finances. It's not easy. But however, wise investing involves, in our opinion, more than reacting to headlines that may discuss consumer sentiment or geopolitical developments. For investing opportunities, one approach is to stay focused on the fundamentals, like a company's earnings or actual economic data. So while we've gone over a lot today, if you remember just one detail from today's presentation, we hope that it's this one. And I'm going to repeat it twice. Emotions have no place in investing. Take your emotions, remove them, give your emotions to me, let me help manage those, but emotions have no place in investing. Market corrections are a normal part of any kind of market cycle. And yes, we saw a vivid and compressed illustration from March through May of this year of a pretty significant market decline. At one point in time, the market was down year to date almost 30%, which is what those red dots would be for each of those individual years. And what this chart shows is that those intra-year lows, going back to 1980 in the red, with the annual returns in blue. Okay? So in 2019, just as an example, we experienced a 7% decline intra-year, but a 29% gain by the end of the year. So far this year, the markets are on a different trajectory, reaching historic highs in February, plummeting in March due to COVID fears and economic activity shutdowns, and demonstrating a strong rebound in April, May, and June, and into July. So remember what I said, the intra-year low this year was almost down 30%. And I understand how volatility can be uncomfortable, but it is normal. And it's my job, and I've said this to everybody that's met me before, to be that financial therapist. Drowned out some of that noise that you hear from Motley Fool or Yahoo Finance or MSNBC or CNN or Fox News or whatever source of media that you're consuming, Facebook, Instagram, daily newsletters, and make sure that we focus on the fundamentals of the companies that we want to own. Ultimately, taking a long-term view of the market is essential when you're trying to pursue your long-term goals. So if you feel concerned or want to understand what's happening, make sure you lean on us for that support. We're always here for you, and we want to help you make the most informed decisions for your financial life. And what this slide shows is why it's important to ignore headlines and focus on your time horizon, the risk tolerance, and your individual specific goals. If we look back at the beginning of 2000 to the end of 2019, we can see the danger of missing some of the most important daily jumps. And as this chart illustrates, a $10,000 investment in January of 2000 would have more than tripled in value to $32,000 by the end of 2019. That's despite the 2001 crash. That's despite the 2008 crisis. Now, had an investor been out of the market and missed just 10 of the best days during that 19-year period of time, just 10, the investment would be worth only half as much. It would only be worth $16,180. If you miss just the 10 best days in that 20-year period of time, 19. If an investor missed just 20 of the best days during this 19 or 20-year period of time, they would have essentially gained nothing. Okay, you made $167 right there, the third line from the left. So if you miss the 10 best days, you cut your returns in half, from 32 to 16. If you miss the 20 best days over 20 years, you cut your returns from 32,000 down to 10,167. So over 20 years, you made $167. Investors who sell stocks in response to difficult market conditions often miss those all-important, what we call best days, because they often occur when everything seems so negative, right? And by the time the clouds clear, and by the time the sun starts to come out, the market's already moved. So staying invested, shifting allocations is one thing, but completely selling an equity investment because of something that you heard or you feel is not prudent based off of kind of what we showed here. Now, obviously, every situation is independent, but if you just missed the 10 best days in the last 20 years, your investment returns would be cut in half. So I implore you to stay invested as long as it's prudent and as long as it makes sense for you guys. So with that said, I'm going to see if we have any questions. If you have any questions, make sure you type them in. Okay, so I've got one question here, and it basically says, where do we see the economy going into 2021 based off of where the presidential elections are? So we try not to put too much amount of focus on the president or the Congress when we're making investment decisions. It's going to happen how it happens. And if we, for 1 second, believe that these billion-dollar corporations can't navigate any kind of landscape or any kind of market, then we would be a fool to place our clients' assets with them. So we just want to focus on actual companies and what they're doing, not political environments or headlines. Okay, I think that's it, guys. Well, I want to thank you. Thank you until next time. Thanks for listening to the Halftime Report this year. I hope you found it informative. If you do want to send it to anybody, we will be uploading it onto our YouTube page and sharing that with our clients. So if you had a chance or want to share this with anybody, you have the opportunity to. So thanks for your time. I appreciate everybody, and have a great rest of this year. And I look forward to speaking or seeing you guys from now until the end of 2020.